Okay, we're going to get started now. Again, this is Adam Goldstein, Chief Business Officer at the Federal Home Loan Bank of New York, and we welcome you to today's webinar. Today, experts from Deloitte will discuss ESG, environmental, social, and governance factors. This is a growing topic within the financial services industry. We've been hearing a lot about it from our members, from our regulators, and your regulators, in addition to elected officials. We had Deloitte present a similar presentation to the management committee and the board of the Federal Home Loan Bank in New York as part of our planning for our long-term strategic plan. They did such a wonderful job, we thought we'd invite them to speak to you folks, our members, to share some of their insights on the ESG market. Also want to note for our next upcoming webinar, Crisis, Regulation, and Technology, the Complicated Past, Present, and Future of Financial Services. That will be presented by Professor Tom Vartanian. Professor Vartanian will discuss his new book, 200 Years of American Financial Panics, Crashes, Recessions, Depressions, and the Technology that Will Change It All. For those of you who attend that webinar, we'll be purchasing a copy of his book for you and sending it to your shops. A couple highlights before we get going on today's webinar. We encourage you to take advantage of that special offering that we have outstanding for our members, where you could book a fixed rate advance, non-amortizing, with a term of 2 years or greater, and receive prepayment symmetry, where there's no charge for that. That's a 2 basis point special for symmetry for your advances with us. We also want to note that on May 21st, that marked the application deadline for our 2021 Affordable Housing Program round, through which we will award about $36 million in grants, and we will announce grant awardees later this year. Also on May 3rd, our 2021 Homebuyer Dream Program round opened with $16.3 million available for grants in support of home ownership opportunities, and that round will remain open through November 30th. The Homebuyer Dream Program offers grants up to $10,000 with up to $9,500 for down payment and closing cost assistance to eligible first-time home buyers purchasing a home through one of our approved community-based member lenders, and also affords up to $500 on the defrayment of homeownership counseling costs. And finally, we continue to onboard our members on the new MAP program, Mortgage Asset Program, and it's a little bit hard to get an appointment right now, but we'd love for you to give us a buzz if you're interested in receiving a one-on-one presentation to your management team on that program. We have a bunch scheduled in the next week or so, but after that, it opens up a little bit. So just give us a holler, and we'll be happy to go through that program with you. Just final details before we get going on the webinar. If you have any questions, please submit them at any time through the question box, and we'll answer them at the end with a Q&A session. Also, we're always looking for ways to enhance the programming for our members, so please complete the survey that will be sent to you following the webinar. These topics are very important for making sure that we have the most relevant content for you, as we really appreciate you spending this time with us on these webinars. Speaking of appreciation, I appreciate my friend Tom Citino, Vice President, Director of Member Relations, who's going to take it over from here. Tom?
Hey, thank you, Adam. Good morning, everyone, and thank you for joining us to this webinar. It's really a pleasure to introduce the Deloitte team today, or to have the Deloitte team with us today. We do work closely with Deloitte as business partners, and we really value the relationship and what they bring to our organization. So kicking off the ESG and climate risk webinar is Ricardo Martinez. Ricardo is a principal with Deloitte in their risk and financial advisory business. Ricardo presently specializes in non-financial risk management. But he's been with, he's been servicing the financial services industry for over 20 years, specializing in credit and market risk management. Ricardo has also led Deloitte's global derivative regulatory reform practice since the enactment of Dodd-Frank. He's also served as the lead business partner for the European Central Bank, where some of the original climate risk regulations and guidance originated. So it's really a pleasure to introduce Ricardo Martinez. And with that, I'm going to turn it over to you, Ricardo.
Thank you very much, Tom. Really appreciate the invitation to present in this very important and evolving topic. And I will be joined by my two colleagues, Corey Goldblum and Mike Monaco, who will introduce themselves as we get into the next parts of this conversation. So if we can start kind of setting the expectations on what this session will be about, if we can move into the agenda, please. Thank you. We will start with a basic understanding and general concepts about ESG and climate specifically. It's a little bit of level setting, as there's different ways of looking at this particular topic. We will try to make it relevant and actionable to members. So we will look into particular cases and things to watch out for as you think about ESG and climate risk programs. Relevance means understanding the business and regulatory implications of this new topic, as well as the specific steps to initiate change. So we'll try to make it actionable, and we will look forward to addressing some of your questions towards the end of the session. So that's how we build the agenda. We look forward to an engaging conversation, and we will start with an understanding of ESG topics in general. ESG may seem well defined, and maybe it is at the ESG category level. But when you go beyond those three, the components are not always self-evident. The best way to define ESG is to look at the typical themes under each one of those categories. And there's no consensus across the industry of what those categories will be, but I think we have a pretty comprehensive list. When financial institutions perform sustainability assessments, there are two views. The first one is the individual firm's behaviors and impacts on others. And that's what this particular slide conveys. So you could be looking in, for example, environmental footprint. What is the impact that a particular institution has on climate change, on local pollution, any waste issues, use of water, for example? Those would all fit within the environmental category. Under social, we typically divide between community relations and employee relations. Under community relations, you can talk about human rights abuses, or local participation issues, social discrimination. You can bucket a couple of them and come up with an understanding of the impact that firm has on financial inclusion, for example. But these would be the more granular topics. Employee relations could include things like forced labor, child labor, employment practices, discrimination, and so on. And last but not least, governance includes practices related to corruption, bribery, fraud, tax, and so on. There are a couple of topics that don't fit neatly into any one of those categories, and those are what we would call cross-team issues. So think about products and services that, for example, finance carbon emissions. That would be a product or service that could be seen as social because of the implications on that particular community, but could also be seen as environmental given the downstream implication it has on the global greenhouse emissions and the global pollution footprint. So many of these topics are covered by third-party risk assessments. They are also used by ESG data providers as they rate individual firms. And I mentioned already a couple of examples. But think about these topics as potential use for self-assessments as well. In many cases, firms are engaging into individual ESG materiality assessments. So understanding what of these topics could be material for them to disclose and for them to communicate into the market. In some cases, it also drives what type of disclosures can be provided into the market. The most visible would be the climate-related disclosures, for example. There are standards that are evolving. Corey will walk us through some of those standards later, for example, in terms of the TCFD disclosures, the Task Force for Climate Financial Disclosures, linking to what do you want to communicate to your different stakeholders, either internally or externally, about your climate change practices. So all of that is the first side, which is what are the individual firms' behaviors. The other side of the coin is how firms are subject to risks across these categories. Those risks would normally represent accumulated individual effects of climate change that represent risks that need to be mitigated. So using the environmental and climate change as an example, if you look at a risk, it's not what you do to the environment, but the impact the environment, in this case, environmental and climate change, can have on you. But they also include the risk of not meeting specific expectations. For example, it is expected that your firm does not discriminate. It is expected that any financial firm has anti-corruption and anti-bribery practices. The risk would be of not meeting those expectations and not meeting expectations not only from internal, but also external stakeholders. So the ESG programs need to look at both your individual practices as well as how you manage the risks. But this particular presentation will focus on the risk side, including the language and the concepts that need to be very precise to manage those risks. So now that we have looked at the general components or typical components of E, S, and G, let's now look at it from the risk angle. We have a similar breakdown of environmental, social, and governance risks, and you will notice that the wording has changed. In some cases, it's associated to the ESG topics, but the wording actually changes. And climate risk is the most visible or the most talked about out of all of them. Climate risk has been called a systemic risk to the financial markets, and that would materialize if institutions failed at managing it at the industry level. This is not a complete list, but you will see that the language is, again, very specific to potential manifestations of individual ESG risks. Climate itself is divided into physical and transition risk, and we will actually go through very specific examples about how physical and transition risks can manifest as business risks in financial institutions. A third potential breakdown of climate risk is what is called liability risk. This is most applicable to insurers as it includes payouts related to climate events. Liability risks also include potential legal liability, for example, derived from misrepresentation of investments as green investments. Think about green bonds and impact bonds, when in fact they don't meet that criteria and specific parameters to be called green or impact related. That misrepresentation can raise the potential legal liability risks that would also fall within climate. So I just wanted to get the terminology right, and just to summarize, there are many elements within E, S, and G categories. These can be assessed as individual firms' behaviors and practices, or as risks as the aggregated effects impact on a particular organizations or when expectations are not met. Again, this presentation focuses on managing ESG risks with a particular focus on climate risk. With that baselining, I wanted to ask Mike to walk us through the so what. What does climate risk actually mean in terms of business management of things that you already cover within your institutions? So Mike, thanks for sharing and walking us through these next slides.
Thank you, Ricardo, and good morning, everybody. Appreciate your time and attention here. So yeah, as Ricardo said, with this slide, what we wanted to do is explain in a little bit more detail the concepts of physical and transition risk, which you see on the left, and then highlight how those physical and transition risks can actually manifest themselves in business risks that are relevant for your organizations. Things like credit risk and market risk, as well as a number of non-financial risks, and the mechanism by which that happens, something we call transmission channels, which you see in the middle of the screen here. So let me first start by just maybe providing a little bit more of a definition of physical and transition risk. With physical risk, it's essentially what most people intuitively think of when they think of climate risk, things like weather events, hurricanes and sea level rise, all of those kinds of things. And a lot of people will decompose physical risk further into two categories. The first would be acute risks, which may also be referred to as catastrophic risks. So those are like the floods and hurricanes and tornadoes, that kind of thing that can have kind of an overnight impact. And then you also have a concept of chronic risks, which maybe take time to develop. Things like long-term temperature changes and sea level rise, which are a little bit less predictable and maybe more of an outcome of how, as a planet, we tackle the concept of climate change. So that's what physical risk is all about. Transition risk is sort of the other side of the coin, and maybe a little bit less intuitive, but is essentially what what people are doing to respond to physical risk, to better understand it and to mitigate it. So you have things in the physical risk category like regulatory policies. Maybe you can think of a carbon tax as being a classic example of a transition risk. And then other things like technology developments, the use of electric vehicles, changing consumer preferences, all of these things that relate to human decisions about how to think about managing climate risk on the physical side fall into the category of transition risk. So I'll just pick one example to highlight this concept of transmission channels and explain how these risks can result in business risk. And then on the next slide, what we'll do is go into a little bit more detail with some real life examples of how they might be applicable for the for the member organizations. But the one example maybe we can pick is a physical risk. So we can think about something like sea level rise, and imagine what might happen if sea level rise continues. Unclear the exact rate, but maybe 6 inches, 12 inches over the next X years could result in either direct property damage, or as sea level rises increase, could actually result in a decrease in the valuation of properties in coastal regions. And what that translates into is, in some cases, depends on your business, but for example, if you have a loan which is backed by that property, that can translate into credit risk, for example, in the banking industry, or could translate into insurance claims. So let me flip to the next slide and explain in a little bit more detail, or give some more examples of physical and transition risk, and show how they can impact various organizations from different perspectives. So what we've done here is looked at physical and transition risks from two considerations, or two directions. This isn't necessarily a comprehensive list. I would think of this as sort of an illustrative matrix which gives an appreciation for some of these risks, but certainly not comprehensive. But the two considerations on the left are the way physical and transition risks impact real estate markets, and that could be from a banking perspective in terms of mortgages, but also from an insurance perspective in terms of underwriting housing insurance, and then also how that might impact, for example, wholesale lending. So just to start out with real estate exposure on physical risk in the upper left, I think we already went through a couple of, or at least one example of sea level rise being a chronic physical risk impacting property values, potentially collateral values, and which could lead to things like defaults in credit markets, or increases in insurance claims. And at the same time, I think that example is for chronic risk. The same holds true for catastrophic weather events. So certainly hurricanes, for example, tornadoes can cause damage to properties and have similar impacts on mortgage borrowers or insurance policyholders. On the right-hand side, I think the transition risks associated with real estate markets are maybe a little bit less intuitive, a little bit less clear. But you have things like changing consumer preferences and policy incentives maybe impacting the demand for things like energy efficient homes and green lending. We've seen this as more of a trend in Europe, where in some cases, even when it comes to underwriting mortgages in real estate markets requiring energy efficient certificates as part of that process. So maybe not something that's happening here in the U.S. yet, but a maybe a foreshadow of the types of things that might happen to come. We also actually just had a conversation with a vendor who was doing an assessment around potential flood impacts and was giving us a picture of what it might look like if FEMA redefines its flood maps and how that might impact the valuation of properties in newly defined flood zones. So that type of thing could certainly have a big impact on insurance markets as well as collateral values for loans at banks. So that's kind of the real estate exposure portion. And then to give a few more examples in wholesale exposure, looking at the bottom left here for physical risks. I think the key idea is that financial institutions that are giving loans to counterparties that have concentrations in sectors that are sensitive to physical risk will essentially indirectly adopt that physical risk. So if you have a direct loan to a household, that's certainly clear, but there are other sectors, like agricultural or CRE, for example, that may have significant exposure to physical risk. And then, essentially the business impacts can be very similar in terms of decreases in collateral value, potential increases in default rates, and that kind of thing. And then lastly, looking at the bottom right to give some examples of transition risks, I like to think of this in two ways. The first bullet is kind of looking at the risks that organizations are actually undergoing in their own transformational efforts, sort of what Ricardo was alluding to a couple slides ago. As organizations respond to regulatory requirements, maybe increase disclosures, quantify things like financed emissions, all of that relates to transition risks, for either compliance, operational costs, but the potential of liability risk stemming from what's being disclosed. And then, the other flip side on transition risks is what is being financed in the wholesale market, and similar to financing a loan, for example, that's heavily exposed to physical risk, you can also have a loan that's heavily exposed to transition risk. And the examples we have here are the energy and transportation sector. So, for example, if you have a loan to an oil and gas company, and all of a sudden, there's a carbon tax that gets introduced that could have a big impact on that company's bottom line, and then translate into potential increase in default within that sector. So these are just a few examples. I think we'll get into maybe a little bit more in the coming slides in terms of how to actually think about managing these risks, but just wanted to highlight these to make those concepts of physical and transition risk a little bit more tangible. So let me, with that, turn it over to Corey to talk about some of the trends in regulation and in industry.
Excellent. Thanks, Mike. If you can move the next slide, I appreciate that. I guess before I start, just quick intro. My name is Corey Goldblum. I'm a partner based in Atlanta, and I lead our credit risk practice for Deloitte in the U.S. Work very closely with Mike and Ricardo as part of our climate risk leadership team. So credit and modeling, scenarios, analytics, capital, all pretty well tied together with everything we're talking about here. So glad to be on and appreciate the opportunity. This slide here, slide 7, highlights a timeline of what we've seen in the U.S. in terms of climate risk regulatory developments. And this focuses on really 2019 and 2020. I will say that we have a slide like this that is specific to Europe. In Europe, you'd see they're a little bit more, a little further along than we are in the U.S. But we are starting to see some pickup in momentum and activity, especially in late 2020. And so much is so that the next slide will show you some activity in this year. So things are definitely starting to pick up. A couple noteworthy developments I think are worth calling your attention. If we focus on sort of the middle right-hand side of the page, the DFS, they issued some guidance, and I apologize if you can go, Mike, back to the 2020 slide. Thank you. The DFS in September of 2020 issued a letter to New York regulated insurers, basically stating its expectations that firms need to be beginning to integrate climate-related risk into governance frameworks, risk management processes, strategies. And then they followed up that letter in October 2020, kind of expanding those expectations to all New York regulated financial services firms. So that was an important development. We also saw in September 2020, the CFTC published a report on the impacts of climate risk to the U.S. financial markets. And what's important there, it asserted that U.S. agencies have authority over climate risk, so there's no additional need for legislative action. And it also kind of proposed the idea of around expanding public-private partnerships. So thinking about like regulatory type sandboxes to help advance the industry's understanding and focus on climate risk. And then we saw really in November and December some movement from the Fed. First in November, they officially acknowledged climate change as a systemic financial risk, which was really important. And then the Fed formally joined the NGFS in December 2020, which is a group of central bankers and supervisors that are focused on managing the financial risk of climate change globally. So those are some of the key developments from 2020. And then if we move forward to the next slide, in 2021, we had, not given the change of administration, we've really seen regulatory focus on climate change and climate risk, really continue and even pick up in this year. Still, just to caveat, there's still very limited formal guidance and policies issued to date. But I think everybody that focuses on the space, clients alike, the sense we get is that it's coming. And so it's just a matter of time. And some of the signals of that is, we've seen the Fed, establish a new leadership committee that's focusing on supervising the banking system for climate change around financial risk. Treasury Secretary Yellen, proposed new efforts to address climate risk in her confirmation hearing. And then we've seen quite a bit from the SEC. They've appointed a new senior policy advisor to focus on climate ESG. They set up a task force that's really focused on proactive identification of ESG misconduct. And they even highlighted climate risk as a 2021 exam priority and then issued a risk alert for ESG investing. So decent amount of activity there. And then, not on the slide is as of a few days ago, President Biden signed an executive order on climate change. And it really focused on the role of government agencies, but also includes a section encouraging financial regulators to increase oversight in managing financial risk. So we expect this will help accelerate action from the Fed, here, in the coming period. So with all that said, I would say this is probably a lot to keep track of. There's a lot of activity, and it's not just limited to the U.S. There's lots of activity around the world. One of the things that we try to do to make it easier for folks is we publish a monthly newsletter on climate risk regulatory developments, and you can see that on the bottom left-hand side there. There's a link, you can sign up, you can have this automatically emailed to you. download it. And so hopefully we did something similar to this for other major initiatives, things like LIBOR transition, and folks find it very helpful just to keep track of all the moving pieces and have it summarized in one place. So with that, let's move into slide 9, which gets into more of the broader global ecosystem of organizations and entities that are focused on climate risk. And the way we generally think about and organize it is broadly in 5 categories. So top left, we've got sort of international initiatives, and these are organizations that are focused on standards across a variety of climate topics, whether it's disclosures, modeling methodologies, other approaches. A good example of this you'll see is the TCFD. That's a task force on climate-related financial disclosures. They've pulled together guidance for companies across industry to provide guidance around climate-related disclosures, which are voluntarily at this point, not mandatory. And I'd say within the financial services, we really just see the largest organizations, making those disclosures, but quite a bit of a catalyst. Plenty of companies wanting to follow suit, and just the disclosures themselves are a catalyst to get people moving and building capabilities, because it's one thing to disclose, but it's another thing to actually have the program and the actual capabilities underneath it to be able to adhere to those requirements or those expectations. If we move into the bottom section, the bottom left, we have sort of research organizations, resource institutes. They're focused on more of the climate science research. And so, the IPCC is a good example of this. They're publishing greenhouse gas emission scenarios that a lot of folks use to help as a starting point in understanding, what does the science look like under different global warming scenarios, and depending on what we believe the actions that will be taken in terms of the transition risk that Michael mentioned. And then on the right-hand side, we have, of course, the regulatory authorities. They're going to be establishing and are establishing regulatory requirements and expectations. I'd say this is, to date, it's been more, as I mentioned, more prevalent in Europe. The Bank of England is worth calling out here, in that they've launched first round of exploratory stress tests. Actually, it's launching officially next month, and they'll be due at the end of September. But they're providing a lot of the guidance, requirements, templates, questionnaires around that first official climate stress test coming out of England, and other countries are expected to follow in 2022 as well. So very interesting there. Obviously, the regulators play a key role. I'd say the fourth category is on the right, middle right, rating agencies. Rating agencies have been incorporating ESG and climate risk into their rating processes. There's, it's not fully transparent in terms of exact details of how it all gets factored in, but there's plenty of firms that are developing ESG scores and various different data and metrics, and it's definitely something that they have been incorporating into their rating processes, and have actually a decent amount have received noted downgrades because of ESG scores. So the rating agencies are playing a key role in helping to drive how climate risk and climate change gets incorporated into the financial system. And then last but not least, on the bottom right, we highlight data providers, and there's sort of a never-ending list of emerging data providers in the space. Really helpful, very important, vendors that are focusing on data for physical and transition risk, as well as some of the key ESG metrics. And there's different firms specializing in different areas. Very interesting stuff, and something that's evolving. As we think about how do you quantify and measure, greenhouse, the carbon footprint exposure of your clients, of your, whether it's your borrowers, whether it's your companies that you're insuring. There's lots of different angles, and then once you sort of understand footprint and exposure, then it's well, then how do we factor in kind of the scenarios and the economic input or the economic impact and the changes and kind of incorporate it in a very thoughtful, methodology. And so the data vendors and model vendors as well, play an important role into this as well. So it is a global ecosystem. It is fairly dynamic and emerging, but hopefully this provides a pretty good summary and context around some of the key players and how we think about the different categories of folks. So with that, why don't we move on to the next slide? And I think Ricardo is going to pick up the piece talking about the climate ERM framework.
Thank you very much, Corey. Yeah, we're getting into the final stretch. I'll try to take the last 5 to 10 minutes and allow some time for Q&A. The last point you made about data providers, yeah, there seems to be one new data provider coming up every single week. But I think you covered the most important ones, or at least the ones that have been there for a little bit longer. Now that we have covered that kind of outside view in terms of what the regulatory landscape is, who are the stakeholders, and so on, I wanted to bring it back into what firms are doing to manage climate risk. And one of the elements that we have been helping organizations with is embedding climate into their existing ERM frameworks. It's not about creating a new framework, it's about figuring out how climate fits into that framework. Not all of the industry as a whole has not really implemented it yet. It's a journey, and it's going to be a couple of years until climate is fully integrated into ERM frameworks. Just want to give you the key aspects. And we have our own framework that we use to guide the conversation. The first step in the framework is looking into governance and policy. It includes developing an enterprise-wide policy with clear roles, responsibilities, a climate taxonomy, including definitions, escalation protocols, reporting, and change management processes. It also includes integrating climate risk into the firm's vision, mapping to specific risk owners for climate-related risks, and how to be effective in cascading the climate change strategy throughout the firm. That will be about governance and policy. Risk strategy and appetite is about embedding climate considerations into the strategy and into the business models. So factoring current and future financial and non-financial impacts from climate change into the firm's risk appetite would be one, for example. And these risk appetite statements tend to be very qualitative at the beginning because metrics have not really evolved yet. It's not as in market or credit risk where you can create a risk appetite with very quantitative metrics. It is very qualitative for the time being in climate. Risk assessment, measurement, and analytics includes establishing quantitative, and also qualitative approaches for identifying, assessing, and prioritizing climate-related risks. Going through the transmission channels that Mike alluded to, it's a good way to think about how climate may manifest as financial or non-financial risks. And it includes techniques like scenario analysis and making sure that the infrastructure to conduct that scenario analysis exists. Monitoring and reporting includes thinking about which tools and metrics will be used to monitor the firm's exposure to climate-related financial risks. It also includes thinking about a disclosure of what are the material risks, both publicly and potentially to the regulators, and implementing the processes and controls across the three lines of defense to satisfy ESG regulatory commitments for managing financial risks. And I mentioned ESG because a lot of the elements of the framework can be extrapolated or used across other ESG risks as well. Portfolio and capital management is related to aligning the product offering to the climate change strategy and implementing a controls framework to support it. Risk data and systems is still evolving and includes implementing a climate risk data architecture and systems to track internal and external sources of climate risk data. Some of them Corey mentioned before. It also includes integrating the systems and data from applications already operating across the enterprise for effective and/or intelligent risk management. And last but not least, a risk operating model that includes people and culture. Includes aligning to the climate strategy across all lines of defense, the control environment, accountability, taxonomy, and enterprise-wide tolerance levels. It also includes establishing a climate risk advisory committee to addressing climate risk and opportunities. This is still evolving, and I would say very few firms have gotten to that point yet. Again, these 7 steps is potentially a multi-year journey. The first elements of the journey, so governance, risk strategy and appetite, and some of the risk assessments are starting to flourish within specific organizations. In Europe, largely as a mandate from regulators that are already mandating climate stress testing and are putting out climate scenarios. So that is within the risk organization. If we can go to the next slide, we wanted to analyze how climate and ESG in general affects all different functions of a typical financial services organization. And you can almost kind of replace ESG and risk, and they will be very, very similar. What I wanted to mention is that all the different functions, including operations and technology, which are not listed here, have a role within the journey. On the left-hand side, we can see strategy in terms of the products, sustainability functions. Many large organizations have created the role for a chief sustainability officer that includes monitoring and linking into climate risk. Front office markets and products is about the business opportunities that evolve from climate risk. Green bonds, for example, would be one. Communications are about establishing a link to the market and conveying what is the story within the organization. And then procurement and HR, making sure that the business and the suppliers are consistent with those values and standards. As I mentioned before, many of the ESG topics could be linked to the third-party risk assessments. So I covered the left-hand side of this chart, and I did it on purpose because the right-hand side is largely linked to risk, compliance, all the control and support functions that need to be part of the journey as well. And what we have seen in before what the role of each function is that many organizations start the climate risk journey and ESG journey from a product and business angle. And in some cases, that could create an imbalance in organizations. If you're creating, for example, new products and services to take advantage of opportunities from climate risk, again, going back to the old example of green bonds, the risk and compliance organizations need to be part of that journey to balance that across the board. And in some cases, that imbalance has created a little bit of friction within organization, and they need to accelerate the right-hand side of the slide, if you will. So some of the key components for risk, I mentioned the ERM framework. For finance is including climate-related financial risks into pricing, forecasting, budgeting, and obviously capital allocation. Legal is related to managing the liability risks. If you remember what I mentioned, the climate risk, I mentioned physical transition and liability risk, which includes legal liability. Compliance is looking at the complex regulatory and evolving landscape that Corey mentioned. And internal audit is making sure that those risks and plans are actually met within the third line of defense. So there's something for everyone. Not everyone needs to be super active right now, but I would kind of highlight the need for balancing the left-hand side of this chart versus the right-hand side as key control and support functions. We can move to the next slide, Mike, and this will be the last slide before we get into Q&A. We have talked a lot about theory and concepts and so on, and we wanted to leave you with a view about how to actually initiating change. It's not always the case that people will start with a risk framework or with a business strategy and so on. Typically, the strategy starts with establishing an ESG framework. So looking at governance for ESG and climate risk, they need to be associated and linked, and establishing what is that vision, including sustainability metrics and targets. The second, especially from the risk side, is looking at that exposure analysis. Consider your portfolio characteristics, including in terms of geography, counterparty loan profiles, obtaining the risk data to assess the portfolio, again, looking at the materiality of those risks, overlaying that data into loan portfolio characteristics to understand what are those key risks. If you get to that point, considering climate risk scenarios to understand impact on key portfolios, Corey mentioned IPCC as the provider of some of those scenarios, developing or highlighting what are the key risks, calculating the impacts on the portfolio attributes, let's say defaults or recoveries, considering the impact of those scenarios on strategic objectives, and last but not least, making sure that climate is embedded into the risk framework. So it really comes full circle. If you focus on the top side of this slide, looking at your framework and doing some basic exposure analysis, that's a good way to get the organization thinking about climate risk, not as an hypothetical, but as an actual risk that needs to be monitored and managed. And I believe that brings us to the last of the prepared slides. And I realize we still have some time, so I don't know if Tom, we would have time for questions. Is it the right time?
Yeah. Would you like to do the questions now, Ricardo? Yeah, we have a little time. We have 10 minutes.
Yeah, go ahead, Tom.
You're okay with
Yes,
that? Okay.
absolutely.
All right. So, but the first question we have here is regarding how far along are financial institutions in the climate risk journey? And making a baseball analogy, are we in the first inning, the third inning, the seventh inning? Where are we with this?
Maybe I will start, and I'll ask Mike and Corey to add. I think it depends on the size of the organization. I have to say that the larger organizations are probably, it's still not an official game. Using your baseball analogy, I think it's an official game after the fifth inning, so it's still not official yet. It's still the first third of the game. But a lot of them have started to think about, well, first of all, appointing climate risk executives, making sure that the chief sustainability officers have a broad view about the program, so they keep that balance between the left and the right-hand side. Looking at taxonomies, and very importantly, a number of them have started to look into modeling capabilities that they will need in the future. If you look at Europe, they're more advanced than in the US, but I would have to say that in the US, it's only the larger organizations that have actually invested heavily into this journey. Again, starting with appointment of climate risk executives.
Okay. Thank you very much. So the next question is talking about how they understand that they need to manage risk, but is that all that they should be doing? Should they be creating products to help foster positive changes to climate change? So what's your opinion on that? Ricardo?
Yeah, sorry,
you're on mute.
Yeah, no, sorry, I was trying to unmute again. Sorry, I was too quick muting, not as quick unmuting. So there are a couple of elements. First one is, and I'm glad that you highlighted, when you talk about climate and ESG, is both the risks and the opportunities, so balancing that. But there are many other elements in addition to managing risk, which is what we focus on today. Things like, for example, look at the net zero commitments. Those are very visible when you think about your voice in the market and communications. Think about what type of disclosures you want to share, not only about climate, but ESG commitments as a whole. Most of them are not mandatory yet, but the expectations are increasing. New products and programs, and of course, what metrics and targets you want to think about. One of the critical ones would be the financed emissions. If you read the press these days, there's a lot of conversation about individual contributions to climate risk, what people call scope 1, 2, and 3, but also what are the firms financing in terms of emission? Are they financing, heavy greenhouse gas emitters, or are they financing new green energy companies? And more external stakeholders are looking at what financial institutions are doing in terms of their business profile.
Okay. Thank you for that. I have a couple more questions here. One was talking about physical risk and transition risk. Which one should I be more worried about?
Mike, I think you can take that one.
Yeah, absolutely. I think that the answer to that question to some extent depends on your business line. So, for example, if you do have exposure, as we talked about earlier, to residential mortgage markets, then the link to physical risk is very clear. And I think things like hurricanes can happen at any moment, and certainly have an immediate impact. It's a little bit unclear when the next big hurricane is going to be, when is there going to be the next Hurricane Sandy, or how quickly sea levels might rise. So to some extent, I think while it's sort of clear the impact that physical risks can have, and the fact that they can be immediate, at the same time, other events that have happened recently, things like COVID, maybe even looking back to the 2008 financial crisis, have been maybe bigger disruptors, at least for some organizations, than climate risk. So even outside of physical risk, I think when you think about transition risk and you realize just how quickly things are accelerating in terms of new regulations that are out there, consumer preferences, how quickly organizations are making disclosures, all of this stuff increases transition risk. All of the actions that people are taking to understand physical risks, to manage climate change, to mitigate climate change, all relate to transition risk. All of that stuff is happening today. And what is most interesting to me is that they're really two sides of the same coin, in the sense that the better we do as a planet in mitigating these risks from climate change, the faster we take action, the faster policies evolve, etc. The lower our physical risk may be, but the higher our transition risk may be. So I think, long story short, both are quite relevant. Physical risk is sort of a kind of risk that's always in the background. An extreme weather event could happen, and certainly cause losses. But even outside of that, I think the concept of physical risk and all the changes that are happening in the environment today make it quite relevant in the short term.
All right, thank you for that good explanation. Lastly, this is the last question. We're going to wrap it up today. We have 5 more minutes, but this question relates to TCFD disclosures. You had mentioned those. Can you explain a little more about what that is and whether it's something that should be considered?
Yeah, sure. And guys, I'm happy to take this one. This is Corey. So the TCFD disclosures is it's really voluntary disclosures that an organization came together and said, okay, this is kind of what we would expect. Here's some guidance cross industry, what we would expect firms to use as a framework for disclosures. And it lays out really kind of 4 key themes, and there's lots of good guidance and details within each, but it talks about disclosing your governance program, talking about like your strategy, talking about risk management, and then as well as metrics and targets. So it's a very helpful document that firms can use and leverage to frame their disclosures. I'd say, cross industry, there's probably well over 1,000 disclosures globally. I'd say within the financial services space, we see, more activity all the time, but it's probably largely concentrated into large institutions. And they're also kind of showing their progress and further along than others. But it is helpful. I think that the other key benefit of it, and we've seen this, as I mentioned and alluded to my other comments, is it's sort of a catalyst for really pushing things forward before there's real mandatory requirements, because we've had requests of clients wanting assistance really around disclosure readiness. They said, hey, we're gonna file our first TCFD disclosure in 2022, and it's not just about making the disclosure, but we have to have the knowledge, the capabilities, the processes behind it, and it really forces us to think about how do we build those, how do we stand those up. So I think it is helpful from that standpoint, from just getting the program started, getting things in motion, and it's an area where there is pretty good guidance that people are following, for the disclosures.
All right. Well, thank you. That was a great explanation. We really appreciate you meeting with us today, Ricardo, Corey, and Michael. Great presentation. We've already had some comments that the members appreciated and thought it was very informative. So thank you again. We'll be sending the slides and recording out later today or tomorrow morning for this session. So those attendees on the line here will be getting a link to that information. So I want to thank everyone for attending. Just want to mention one more time, Adam mentioned it earlier, we do have another webinar coming up on June 10th from 11 to 12. The title is Crisis, Regulation, and Technology, the Complicated Past, Present, and Future of Financial Services. It's actually going to be presented by a very interesting individual. His name is Thomas Vartanian. He's an author of a book called The American Financial Panics, Crashes, Recessions, Depressions, and the Technology That Will Change It All. And the attendees will be receiving a copy of the book as well. So we encourage you to join us, again, June 10th, 11 to 12. So thank you, everyone, and that concludes our session for today, and have a great afternoon and good holiday weekend.
Thank you very much.
Thank you.